Hello friends, thank you very much for joining in for today's session. Today's agenda is career opportunities in risk management field. And before we start out with this session, I'd like to give a few just about why exactly we are having this session, what is the purpose of this session and all. And for this session, we have Ankit Srivastava, who has been in the risk domain. He's going to be helping us with this session, his experiences and idea. So let me give you a brief about why exactly we are having this session. So Weave Intelligent is primarily into training for international certifications into finance, especially into FRM and CFA. And when we interact with our students, we realize that a lot of these students are candidates who are currently working in finance or are looking out to join a finance domain. They are not well aware about what all different roles are there, or what all different job profiles are available, what all different skill sets are needed to enter into a particular domain. And that actually led us to start out with these kind of sessions, wherein we'll be asking people from the industry to come on board and have career conversation. And the agenda of this discussion is primarily on career, how to build up a career in a particular domain within finance, and how to what all skill sets are needed for a particular role, and how to go about acquiring those skill set. So that is the entire aim or the agenda of the discussion. And today we have with us Ankit Srivastava, and I'll just give you a brief introduction about Ankit. He's been a good friend, and he has been also helping us in a lot of other stuff. He has been involved into risk management for a long period of time, and he, in terms of certifications, his background, successfully completed FRM certification from GARP Institute. He's also completed CFA from the CFA Institute, and also he's a MBA pass out from Faculty of Management Studies, Delhi, which is one of the premier B schools of India. And he has been working in the risk domain for a long period of time. And today, the way we're going to be going ahead with this session is that we're going to be having few questions for Ankit, okay? And those questions will be pertaining to different teams within risk management, what they exactly do, and how exactly these teams, what are the different roles these teams have, okay? And but before starting out that part, I'll call upon Ankit to give a brief introduction about himself with respect to his journey in the industry within different companies, and what has been his role in those companies. Thank you, Ankit, for joining in. Over to you.
Thanks, Dinesh. Thanks for having me here. Uh, uh, and thanks everyone for being here. I can see that there are 37 attendees. Thanks for taking time out on Sunday uh, to hear to us. Thanks a lot. I'm Ankit Srivastava. As Dinesh told earlier, I completed my CFA and FRM. Both I completed during the while working with different organizations. And I started my career after my MBA as a proprietary trader. As a proprietary trader in Future First, a company which you have heard about, might have heard about. There I traded currency futures. I was trading Euro USD and GBP USD in Chicago Mercantile Exchange, the CBOT exchange. There was a lot of exposure of technical analysis, a lot of exposure on economic metrics, and it was a great experience, a great learning experience where you actually see how the statements told about informed by the different leaders actually affect and move the market. From there, I moved to ICICI Bank, where I was in global markets group for 3 years. I was responsible for relationship with large corporates and responsible for their forex hedging, forex interest rates, and other hedging, non-basically market hedging. There I gained experience of client relationship management, how they are managed based on, thanks to my earlier experience with Future First. It was a very good place where I could help some of the very large corporates, which name you here. I met some very wonderful people, the CFOs, the treasury heads, and understood how the industry really works. It was a great experience, and then one of my friends in Nomura contacted me over this role in risk management, and this was a very interesting phase. It was in 3 years. I was getting good promotion, good recognition, and it was a very good place to work. But sometimes when you have read, you studied FRM, you have studied CFA, there's something that's clicking in you too. understand and practice a little bit more. And there were RBI guidelines which restrict use. I'm nothing against RBI. RBI does a great job. That's why our banking system is so secure. But there's an opportunity to actually see permutation options, different options, kick-in options, the barrier options in practice. I couldn't resist the opportunity and joined Nomura in their market risk and stress testing team. I worked there for 2.5 years. Stress testing, I'll cover in detail in coming slide as well, so I will not talk about that here. After stress testing, I joined risk and control, where I work as an internal consultant to Nomura Risk Management globally. I'm reporting to the global head of risk and control in the role, and the experience has been great. Perhaps that experience made me right candidate or an candidate to talk about the whole of career on risk management in banks today. So that was from my end, a brief introduction. I'll tell you more about myself or my experience. Maybe I'll be able to quote certain examples when I talk about different risk management perspective and coming in this session. Thanks, Ganesh. Yeah, over to you.
Thank you. Thank you, Ankit. Thank you very much for this lovely introduction. And we'll start off with the session. In case anybody has a particular question or doubt, then they can post it on chat, and we'll try to take it in between the questions. And overall, at the end, also we'll be opening up for doubts or queries, which you can directly ask to Ankit also. So that facility will also be there. So with this, let's start off with the session. The first question that we primarily have is, can you please give us the brief overview about risk management in terms of what all different teams are there within risk? Over to you, Ankit.
Before giving you the overview of the exact teams and the different teams that we have in risk management in a bank, I would rather start with what exactly is risk and how understanding risk itself makes the risk management piece easy. So the risk management in simple words is the management of risk, and risk is nothing but uncertainty. If we are facing an uncertainty in our daily lives, what is it that we do? The first step is obviously assessing the potential losses and the potential uh, gains out of the situation. The second step that we can do is that we can create an action plan and act upon that action. The third step that we generally do is to follow up and monitor and review whether our action was correct or not. Uh, if you take any example, and you will be able to understand that this is the way that we handle the risk, the uncertainty. This is exactly the work of risk management in a bank as well. The only difference is that for the bank, there's so many verticals. Like banks are in the business of risk and the business of uncertainty. A bank earns from that risk. So we are in the business of risk, and there is so many risk factors involved, which needs to be assessed for their potential losses. Because one big loss, and we have seen that financial institutions have been wiped out from market. We have to make an action plan, a concrete action plan on which we can act and which we can focus on coming years in terms of resources as well. And as a further step, we continuously monitor and we have to continuously check whether our actions are not in current environment, whether there are continuously new changes. We keep on hearing about US-China crisis. We talk about North Korea escalations. Right now, we are amidst global health crisis, perhaps the worst the world has ever seen. So in that case, it's very important that we continue to monitor and govern those things. I'll exemplify with few examples here before I take you to the individual teams. You might have heard about investing in equity or maybe investing in share. This share can go up and down. At your individual level, the risk is only about share going and going up and down. That is equity delta. When I talk about a bank, the risk is much higher, because when we take a position in equity, it is not only the position that we take in equity delta. Many times we trade in equity markets for gaining, for taking position in volatility, Vega, or in gamma. So we have to take care of each and every position that nothing blows out in times of uncertainty like this. Trade risk is another major factor for us. Many of the banks at SBI and HDFC that you can relate to, we would see that there's a lot of home loans and personal loans coming at it. This is nothing but essentially the risk that the person outside, the woman has given the loan, will not give you back money. Then comes the operational risk, which is from our day-to-day activities, on which I'll explain over in the coming slides. I also see that, as Dinesh pointed out, that there's a skill set that you guys would be interested in knowing and how to develop those skill set to make yourself a better candidate for risk management and finance in general. Uh, as an analyst position, as a starting position at least, the skill set that is required for different roles is pretty similar. In fact, many a times you will see that an organization goes to a MBA college or to even a BTech college and just takes so many graduates for internship and jobs, and later on places them in different verticals as per the requirements at that time, which is very, very practical also, because when you have actually committed and offered the client till the time he joins the client, he or she joins the firm, it's a gap of 6 months to anywhere between 6 months to 1 year. So it's not always possible. So once I have given you the back walkthrough of all the teams, what they do, I will tell you the basic skill sets, and then I'll also add to it what are the essential and add-on skill sets that are required for other particular jobs. Dinesh, over to you.
Thank you very much, Ankit. And so let's start out with one of the big chunk of risk management teams within the entire domain that a bank generally has. So the first one would be primarily a market risk management. So can you please guide us what all different roles or work profile do you see within market risk itself?
I guess you have jumped. You are on side of credit risk management, Dinesh. So market risk management. In market risk management, the teams are generally based out of the asset classes. Now, it is not a rule, but it generally happens. Why this happens? Because those of you who be tracking equity markets will be able to relate to it. Uh, when Nippon or Kospi is on the rise on a particular day, the Nifty also generally follows suit. If there is nothing out of the blue or nothing surprising to the Indian market, it also fluctuates. So does DAX, FTSE, and Nasdaq. For those who couldn't understand, as Nifty is our stock index for the best 50 firms, KOSPI 200, Nasdaq 100, etc., etc. Similar indices in other markets, because of the correlation being very high, or sometimes the interrelation, like in FX, if USD rises against INR by 10% and INR appreciate against Thai baht by 10%, then it is very easy, simple relation that USD has appreciated against Thai baht by 21%. It's simple mathematics. So because of this high correlation and high interdependencies, we generally see the teams in market risk pertaining to single asset classes. The sub-teams in market risk management can be equity market risk management team, FX risk market risk management team, and so on for rates and credit spreads. Now, as because these teams are many a times fixed upon the correlations, you will also see in certain banks that FX and rates are combined together. You would also see in certain banks which do not take positions in equity, or who do not have, let's say, severe desk, or do not have a credit spread desk, which is very prominent. In that case, you will also see that one person will take up multiple multiple uh, designations as well. And actually, today is not a market where you can be a specialist in one particular thing and can be completely ignorant about the other things. You need to have an idea about all the products, at least all the basic products, so that even when the complex products hit you, you are able to understand and you're able to relate to it, because the market is very connected these days. Now, so in the basic structure, as I told, there are four basic asset class teams, but market risk management needs to do other work as well. For example, someone needs to see a cross asset relationship and how does the portfolio is moving. For that, generally the firms has a portfolio analytics team, which look across asset classes and look at the portfolio level and update the senior management on the changes and on the risk which may be happening. Uh, as as a day-to-day role, these risk managers in asset class and in addition to the analytics teams are responsible for managing the limit of the market risk. As I told, there's so many risks and so many positions across the bank. You have to decide that on FX data, supposedly for USD, I will not take a position of more than, let's say, $100,000. So these are the teams which actually look to it. When a trader or when our bank is crossing a position on certain level, they are the responsible for tracking it and asking them to reduce the limit. In addition, depending upon the bank to bank, there can be other teams. Like one team can be looking for MRM strategies. After all, there are so many systems, and you always have to improve yourselves so as to be ready for a future. There can be a dedicated reporting team which takes care of all the reporting to regulatory and other requirements. And especially for an international bank, things become interesting because you have multiple regulators to report to, and especially when you're in US markets, the number of regulators are just huge if you will look at it. Uh, so that was from market risk side, and uh, yeah, that's largely the picture of market risk management, Ganesh.
Okay, thank you very much, Ankit. In order to summarize, primarily, so we have different asset class teams primarily in market risk, which basically look after each asset class risk. For example, you have equity, so you might have an equity team looking at the market risk pertaining to that equity asset class only. Apart from that, we also have reporting related teams who do a lot of market risk related reporting within the to stakeholders within the company, or also stakeholders outside family or regulator, right? So just one small question. So we also generally hear about middle office, right? So there's a particular team called middle office. So if you can give a gist about that also, that would be really helpful for the audience.
Yeah. Uh, So middle office is basically that works from MRM, CRM, other everyone, and every firm, every risk management team has a middle office team. So you see, in a bank, there can be a 1 million positions in a single day, and all of this is flowing at some end to some manual entry in some database, and that database is collating on which you are creating your uh, reports, on which you are tracking the limits and everything. So many of the things can go wrong when one system is throwing the data to another, and adjustments and changes are being done on that data. Middle office is generally the team which takes care of all the data checks and balances. Since Ganesh brought up this topic, for market risk, this team is generally called market risk middle office. For credit risk, it will be called credit risk middle office. For stress testing, it will be called stress testing middle office. Middle office is also the team that takes care of so many other functions which are very critical to market risk. For example, uh, a market risk manager is not always given the rights to make changes to the system. It's just that too many cooks have spoiled the broth. If a data system is being handled and changed and manipulated by so many players around, then there is always a possibility that the data may get corrupted or there can be some inaccurate adjustments that flow to it. So these kind of adjustments are also done by middle office, which is pretty critical to the overall operation of market risk. Thanks, Dinesh, for reminding me about middle office. Thanks a lot.
Thank you very much, Ankit. So we have few queries from the audience. I'll just quickly take a pause. Uh, the first one being from Urvi. So Urvi is asking equity research. Does that equity research team, does that actually comes into market risk? So Urvi, that is not what Ankit was primarily trying to make you understand. So he was primarily trying to tell you that equity as an asset class, that risk will be managed into the market risk team. Equity research is very different. Okay, so you have a different team pertaining to that. Okay, and there are a lot of other queries which are pertaining to international market, how that impacts. So as of now, I will not take that query because we are talking about careers. So probably at the end of the lecture session, we will primarily try to address that query in detail. So, and I'm assuming that all of you are able to hear me properly, me and Ankit both properly. Can anyone can you guys please confirm on the chat if you are able to hear us properly?
Either they are not hearing it us at all, or what is the problem?
They are hearing.
Yeah,
So one or
they
two
are in the
people
chat.
think so. They faced a small slight problem. So it seems that your voice is breaking in between. Okay, so that
Okay.
could be the reason. No worries, that's basically a technical issue. And okay, so a small request from the audience, Ankit, to be a bit louder so that these guys can
Sure.
will be able to hear you properly. So no worries. So I think so we will be able to sort out that issue in some time. So let's go ahead and go to the next question. Next question, which is
Before that,
yeah, yeah.
Ganesh, just one moment. One person, obviously, I guess, asked about the equity research team. Equity research is generally taken care of by the research division in global market. That doesn't form a part of risk management. You will see that these two divisions cannot sit together, and maybe not in this session. In some other session, Ganesh or someone else can point it out how they just simply cannot sit in one division.
Okay. Thank you very much, Ankit. So let's go to the next piece of query, which is primarily related to the next big team, which is credit risk management team. So we'd like to have your views with respect to different teams within that, and what are the general work structure or work profile that these teams have. Over to you, Ankit.
Yeah. Uh, so credit risk is basically, as I told earlier, that it is the risk of you giving the money out to someone and someone does not returning you back the money. That was a simplification of the definition of credit risk management. In actuality, credit risk is everywhere where you have taken a credit, given the credit to someone else. So even if someone misses out on the contractual payment that he or she or the firm was supposed to give, even then there is a credit risk that we are running there. This definition is very important in terms of banks, because then you will see that it is not only the lending and borrowing that exposes a person or a firm to the credit risks. Those of you who have an understanding of the derivatives or OTC products like forwards will be able to relate to it. That when you create an OTC product, also the valuation of that product, that forward or that swap, changes over the period of the whole period of the duration of that product. During this duration, sometimes the bank would be in the game, and sometimes the client can be in the game. When the client in the game, the client is having credit risk over the bank. But this situation, we are not concerned about that. But we are very particular about the risk that we are running on derivative position and OTC product when our counterparty owes us the money because of the current MTM, current valuation of the product. And here, even those banks which are not really in the lending business or not really in the home loan or car loan business are exposed to the credit risk. Credit risk management, I will rather take you through an example so as to better understand the teams that are there in the credit risk. Suppose you have a derivative position with Nestle South Africa. Nestle South Africa came to you to book a forward for it, and you booked a forward for it. Now, the first team that is there in the credit risk is credit counterparty analysis. This counterparty analysis team has to take care of has to go through the financial statement, the cash flows, the P&L statement, and the current situation with Nestle South Africa to understand whether it is a credible borrower or not, or whether we can extend derivative limits and other limits to it or not. Uh, do understand that many a times you also have to actually lend the money in term loans or leverage buyouts and other such cases. But we'll come to that later. That is the first piece, where a counterparty analysis team comes into the play. As the second part, now think about an international perspective. Nestle South Africa credibility is not only affected by Nestle South Africa, but also what is happening in their headquarters in Switzerland. So now you have to take care at a senior level in the same counterparty analysis team, or maybe a cross-region team, which focuses on those, if I can call them single names or the names which are at a higher level at a group level. Again, I have taken the example. Now, this is the second team, or you can say this second management layer that is there. Now, I have taken the example of a corporate. The things become more interesting when you are dealing with a financial institution. If the exposure to a corporate can be in $100 million, uh, an exposure with a Citibank or Goldman Sachs, or the interrelation between the exposure that Barclays and Citibank are having between the two of them can run into billions of dollars. So there is a different financial institution team within counterparty team that you need to take care of the FI. This can be further be broken into the financial institution for which you have the publicly available data and not publicly available. So you see, there's a lot of mix on the basis of the credit data that you have about a bank. But things do not stop there. If I talk about, I have taken an example of Nestle South Africa, so I'll continue with that. One of the major products of Nestle is Nescafe, the coffee which is known around the globe. And they import it from Brazil and Vietnam. If some political situation happens in Brazil, even if the willingness and motiveness and everything else was okay with Nestle, even then our credit quality with the exposure will get affected. So you need to have the third team, the country risk team, which takes care and on real-time monitors the different geopolitical tensions and the changes that is happening in different countries across the globe. They take care of every minute movement, and they also extrapolate and they keep track of all the macroeconomic variables that may affect our exposure somewhere down the line to a small counterparty in South Africa or anywhere else. As I told earlier, there is also a middle office team which needs to be there. And credit risk, unlike market risk, differs slightly from market risk in one thing. Like as I took the example of high correlations in international markets, international financial markets. Many a time, the credit risk is affected more by the geopolitical reasons of that particular region. For example, the Indian profile of credit borrowers and where we have exposures can be very different from the exposure and the kind of parameters that we can see in a let's say Vietnamese firm or an Israeli firm. The parameters can be very different. So many a times you will see in credit risk that instead of global teams, the analysts are also divided as per the region. Maybe not as per the country level, but as per the region. Some fund can be responsible for EMEA region, some team can be responsible for US region, and so on. So that was some credit risk. To summarize, you have a counterparty credit risk team that can be further divided basis corporates or FI. FI can further be divided into the hedge funds or the major banks or whichever the way that the firm's exposure is. We also have a country risk team which takes care of and checking the exposure at country level, because that is very, very important for us. And yeah, that is it. Ganesh, over to you.
Thank you very much, Ankit, and especially for that introduction about country risk team, because a lot of the students or people working within the organization also are not very much aware about a particular dedicated team looking after a country risk within that risk management domain or within that risk management function. So thank you very much for that. And there have been few questions also, but those are more related to skill set and those related to how they can apply for a particular role, something like that. So we'll be taking those questions in the end. I'll quickly move towards the third major team that you generally see in a bank, with respect to risk, that is operational risk. So can you give us a brief about what exactly do they do, and what are the different roles they have within that risk team?
Before giving you the overview of operation risk management, before giving you an overview of operation risk management, uh, I would like to take a step back and will like to tell you what is the risk management that we want to cover in this slide, and what are the risks that a firm or actually faces. We have so far talked about market risk and credit risk, but if you think about it, those are not the only risks that a bank faces. A bank may face a climate risk is a very pertinent risk. Technology risk is a very pertinent risk. We see a lot of legal risk when you are executing contracts with other party. So all of these, there can be catastrophe, there can be an earthquake, and your business may be stopped because of that. So there are so many risks uh, that cannot be accounted for by financial models. These can be because of the system failure, maybe some IT failure or something. This can be because of processes. Everything was okay, but your process was itself flawed, which was giving out which was handling free handout, or that was not able to maintain the records. It can be because of people, maybe the lack of training, or maybe the fresher who joined, or maybe he just accidentally sent an email which was they need to be sent to Reliance instead of sending it to Reliance, sent to ITC. Those kind of situations, and it can be also fraud or external events. To put in, to just to reiterate myself, the over operation risk management is the division of risk management which oversights the risk caused due to this non-financial parameters, processes, systems, people, external events, and IT events. So these are the things which comes under the operation risk management. Uh, Those who have understanding of Basel would remember that for capital adequacy itself, we take operational risk RWA, credit risk RWA, and market risk RWA in the denominator to measure the capital adequacy. Well, I'm saying that to compare the operation risk management unique position vis-a-vis market risk and credit risk. In market risk or credit risk, if our RWA increases, if your exposure increases, it's very easy for you to cut down on the position or even to monitor the position so that you have the required capital adequacy and you have the control over your limits, that the exposure that that you are having. Operation risk management is nothing but our day-to-day operations. We are sending a client an email, we are doing a client settlement, we are running an Excel. I mean, this is the day-to-day operation. We cannot shy away from it. And at the same time, you do not know what will be the impact of one mistake on the side of one fat finger or one wrong email sent to the client. So this puts it in a very unique position, and it has gained a lot of traction in the last 20 years. And there are some very interesting things happening on operation risk side. However, because of this unique position itself, many a time you will see that operation risk management is not sitting in the risk management division of the bank per se, because it has very unique characteristics to itself. Many times it can sit, many times it cannot sit. It's fine. The work remains, and the operations management is great based. Generally, the teams, because of its unique nature, is broken up into the regional and global teams. Why regional and global teams? Because uh, it's sometimes an operation risk happens. Some some possible breaches of data, some possible wrong emails sent. We do not really have the time for a global team to engage with the on-ground team where the mistake has happened. So you always need to have a regional team. Then you have the global team, which oversights the increasing risk over the whole firm. Uh, this team, operation this team is also responsible for risk control, self attestation, which you will regularly see in different job descriptions and all. So what risk and control self assessment is, or RCSA is nothing but firm accepting and recognizing its own risk that it is running, the operation risk that it is running, what are the things that they are doing for it, and what are the actions that can be taken to further mitigate that risk. And this is a very important thing that the firm are doing, and there's a lot of regulatory supervision and focus around these things. And as I told you, it's a very upcoming and up and running field. That's all from me on operations side. Ganesh, you would like to add something? And by the way, I
Yeah.
just noticed that Ganesh was when I met Ganesh, he was with Operation Risk Management itself and with me, and he was doing a fantabulous job, and everyone was very happy with him. It's just that it was a loss to us that he left away. But yeah, it's a gain to so many of you. Great. Over to you, Ganesh.
Thank you, Ankit, for such a kind word. And just a small add-on to what Ankit was primarily saying. So he was primarily talking about the second line of defense that you generally have within the organization with respect to operations risk. And operations risk primarily tries to cover the non-financial aspect about the risk. And but from the career perspective, a lot of these teams also have first line of defense. That means you'll find risk team within operations, you'll find risk team within finance. So there also you can enter into as a career, and then you can gradually move to a proper risk team. This is the second line of defense within the organization. So thank you very much, Ankit. I have got few questions also, but again, those are very much specific to skill set. So we'll wait for the end to cover to that point. And I'm moving to the next bigger section that we generally see within risk management, that is model validation and model methodology team. And this is what not many people know in detail. So what exactly do they do? What exactly is the work profile? So I would need your assistance, Ankit, in this entire thing, and we'll need to have your view and understanding about what exactly these teams are doing. Over to you, Ankit.
Uh, Before I start on the model, since there's so many people who are asking about their skill set and the other requirements of a job, of what is thing, please don't worry a lot about that. First, try to understand what do these positions offer, and when you are there, once you are there, what exactly will you be doing there, so that whether that interests you or not. That's part one. Second part is I'll tell you the story from my MBA days. So this one very particular famous Indian bank, one of the biggest Indian banks, came to our campus, and it came for a particular role. I will not name the role because I do not want to compare any two roles. And it came to a very particular role, let's say a role W. We were Many of my colleagues were not interested in the role W, but they were rather interested in the role C and T maybe. But anyway, few of them applied, few of them got through. 4 months down the line, when there was actually the time of them joining the firm, they were placed randomly in C and T instead of W because the W positions were already filled. So don't worry a lot about the skill set and more about that. Don't worry a lot about the position that you're getting in. If today someone comes to me and talks to me that he wants to be in the risk management, there can be three possibility. Number one, he doesn't have a job. If he doesn't have a job, I cannot take him seriously that he wants to go into risk management because he would say the same for any other role. The second possibility is that he is already in some other division, in other corporate. Then still, my faith in him would not be very high because he is in a corporate. He might be interested in just moving to investment bank, and once he moves to investment bank or a bank, he will maybe change the job. But the third possibility, where you are in any role inside a risk management, and then you come to me that with your resume and you say that you want to move into market risk management and hence you have applied to it, then you have a certain weight that other candidates do not have. So if you are looking for many of you asked the skill set when credit risk was being discussed or when operation risk was discussed, don't worry about that skill set as of now. Be focused that you have to enter into a bank and then always you can change. The banks today have firstly, there is a lot of interfunctional roles. I can give you the examples where the markets and credit risk skills are intermingled and you cannot work with only one skill. So you always get the exposure to another skill. Also, there is a lot of internal movement which helps. So don't worry about those things at this stage. Anything that you would like to add, Ganesh, here, or shall I start with the model methodology?
Please go ahead. Please go ahead. No points from my side.
So those of you who have been in finance interviews or the risk management interviews would have noticed that I talked about the deltas, we talked about credit risk, counterparty, exposure, everything. We are still not talked about the holy grail of the interview questions. The one starts with V, value at risk. We have still not talked about VAR at all. So this is the place where the risk models like value at risk, those who might have heard about extreme value theory, you would have also heard about the historical simulation of the things which come into the play. So model, first I'll take the model methodology, and there is a separate validation team that I'll take to later. It's basically two parts, and both the teams are pretty. So in model methodology, what happens that all of the models that you hear about or the regulations that you hear about, you might be hearing about FRTB. So there's a lot of things which are going on FRTB. There's a lot of talks about banking books. There are different ways of calculation of VAR, and you are also penalized if your VAR back testing fails. You talk about risk theoretical PNL. All of these models come into play are designed by risk methodology group. Risk methodology group is responsible for all the methodology which are used in a risk division, which also adds to particularly to VAR. It is about capital allocation, the different capital allocation methodology that can be used. It talks about risk methodology, in fact, is also the group which generally takes care of all the data, uh, all the market risk historical data that can be that is used by the firm. Think about it. You cannot always rely on Bloomberg because there will always be changes, the number difference between Bloomberg and Reuters. You need to keep a record of the data that you have used in the market, or your particular business needs to use that data. So all of this is also maintained by the methodology. Now, methodology, as you can guess, would be very different from market risk, from credit risk, and so on. So this team further is broken down at least in 4 different teams. Generally, again, it's a general thing. Many a times it can be broken in another way that I'll tell you as well. The first way to break it up is market risk methodologies team. Uh, Incidentally, when you hear MRM in the job description, you will see that they sometimes some firms use MRM to denote market risk management and some do model risk management. So please be very sure of that. Anyway, the first talks out MRM methodology, then can be CRM, credit risk methodology, then can be a stress testing methodology, which I'll cover in some time, maybe after this. And then there is a historical data team, which takes care of historical market data and all the other movements. In case you do not know, it is not only the market data which is historical and important to us. For calculation of simple probability of default, it is very important for us to have the data of maybe 30 years or 40 years of how many double A rated clients actually moved into, actually defaulted, and how did things happen and what was the situation. We cannot always rely on the data that a third party provides us. Okay. So, whenever, so this is the overall background. I will take you with an example just to show what does the model methodology do. So FRTB is the flavor of the banking right now, and there's a lot of focus on FRTB. So whatever the FRTB requirements are in terms of PLAT, profit and loss attribution test, there is a lot of focus on comparing on creating models which are very close to replicating the hypothetical PNL. If you do not understanding this term, it is fine. Maybe in some other session we can talk about them in detail. But to understand the gist of it, the VAR methodology that is used is very important. Now, I would like to add one thing here, one flavor, in case you ever, because this may be a very high level, I will take a very small example to show how a simple thing like war, where you don't have to do anything, you just have to go for an historical simulation and that would be fine. Or maybe run a Monte Carlo simulation and that would be fine. That's theory, right? In real life, the things are not very easy. What happens that you have, whatever the positions that you have today, those positions you have to run on the VAR changes in previous 520 days to finding one day mark. Now, think about what happens in this situation. Suppose on day two, let's say March 13, 2019. On March 13, 2019, ITC share was 100 rupees and it changed to 120 rupees. Possible? When you are creating a VAR matrix out of this data, that ITC share jumped from 100 rupees to 120 rupees on one particular day, there are two ways that you can take this data. There is a jump of 20% in equities that will show in your VAR calculation that on one particular day, the jump can be 20% up. The other way to see it in absolute basis, that ITC share jumped by 20 rupees on one particular day. Neither of the way is wrong. The problem occurs when on today's date, the price of the same share is 500 rupees. Now, depending upon what model you have used, your VAR output can be 550 rupees or 520 rupees, and both cannot be right. For those of you who have a slightly higher understanding of finance, so think about a bank, think about a company whose credit spread was only 10 basis points, but due to some exigencies, some urgent issues, it jumped overnight to 90 basis points. How will you take care of it? Will you say that it was an 800% jump, or will you calculate it as 80 bits? So risk methodology is the team who takes care of all these things, which retains the sanity of these calculations and sanity of other things. Also, I would like to add another example where the risk methodology is very important and very exciting field per se. Uh, risk in credit risk also, when you're an international bank, you get all kind of different collaterals. In our country, the Indian Railways is nationalized. In other countries, it may not be nationalized. Our counterparty may be a company which will offer us railway coaches as collateral. So how will you actually come to a method to value those collaterals? And always remember, as a bank, you cannot rely on this third party alone. Even the smallest of the banks do some research and some knowledge in it, and you cannot leave that. So that is the work of the risk methodology group, focusing on the risk models, the VAR, uh, the historical simulations, and all those challenges that you face while running these simulations and challenges, and also to come out with innovative solution to model the risk factors associated with, let's say, a railway coach. So this was risk methodology. I will come to the validation part as well. But Krish, would you like to add anything here, or do we have any questions here?
Nothing as of now. So no more questions. We can continue.
Okay. So now you have created a methodology. Methodology is created, is largely quantitative in nature, and you have created a methodology, and it is working fine in your situation, and it's super good. Regulations always required an independent validation of these methodologies. Why these independent validations are required? To ensure, see, once you have created a methodology and then you can play around with the capital adequacy and capital calculations, and that may give undue advantage to a bank, and also in a period of crisis that can penalize the bank like anything. So you need an independent validation. That's a regulatory requirement. But in addition, there can be more realistic challenges because of which you will require the validation to happen. Now, by independent validation, I mean the team that uses the model, the team that has created the model, and the team which is validating the model. These are three separate teams, and at the very least, the team which is validating the model is completely different from the team which are using that model or have developed the model. The requirements and regulations in this regard are so strict that those small banks which cannot afford their own validation team, or which cannot have their expertise to own their own validation team, are allowed to outsource it to third party and get it validated. So what does model validation, where this model validation role becomes very important? Think about an example where the companies where there are a credit card company like HDFC has given the credit card to so many people. HDFC, by the way, is the largest credit card company. So it has extended lakhs and lakhs of credit cards and crores of credit cards in the market. When you will see historically, HDFC is comfortable, and the whole business environment, the whole banking system, and RBI is comfortable that the default risk, the probability that the money will not be paid back to the credit card company is, let's say, 2%. It's very close to actual real statistics. So let's say it's 2%. What does 2% mean? 2% mean that for the whole 2 or 3 years, you can have 0% delinquencies, no one defaulting at all. And in the fourth year, you will suddenly see 8% default in one go. Because these are the historical numbers. And there's always a risk that in one particular year, the numbers will jump to anything. I'm not saying that it will become 50% in any year, but there is a very high probability that this 2% becomes 8% or 10% in a year. So a model validation group do these small checks to ensure that the model that it is trying to predict is actually good and actually conservative. Because if at that time HDFC in our example doesn't have the capital to take care of 10% default in credit cards, then it is a big risk of losing the bank itself, or maybe losing the division itself. It will be a huge loss on them. Another practical example can be uh, this happened in 2011 and 2010 when, for the first time, perhaps, we saw the negative interest rate regimes. Even today, when you will open the derivative books or the financial books, you will not see the models which are actually developed for the negative interest rate. Negative interest rate will give you very funny numbers, and sometimes the model and calculation will simply break. It's like division by zero in certain cases. So model validation group as a black box independent function can take care of these things and these faults. Uh, when I talk about models, no, I would rather not go into the details of the model, but for a rough understanding, understand that there are two kinds of models that a bank is really interested in. Risk model, which talk about war and other such parameters which are regulated with the capital calculation, and the other model is the pricing model, because again, as you might have heard already, the Black-Scholes model is something which is in theory and never really used in its own format because of so many restrictions. So every one of us, all the major banks at least, have to come up with their own models to price simple products like options and barrier options and taken options and those kind of things. And you may also able to relate with it that even the volatility surface and Vega are different from different banks. Not every it's just the average of everyone that you see on the market. Like the average of so many bidders and so many sellers that you see at the final equity price. But actually, every bidder and every seller has a different price. That's how the internal models are required.
Thank you, Ankit, for this short introduction. About let's go to the next team, which is primarily of stress testing, and also this is not heavily talked about when we talk about risk management as such. So we'll need a good understanding about this role also. What do you, Ankit?
I would like you to uh, go back and think of us being in 2007 for a moment. You are in 2007, you are in banking industry, or at least you are having a keen interest in banking industry. You see that all the large banks are investing heavily in the real estate through MBOs and SDOs and other products. Now, real estate prices are continuously going up, so there's hardly any risk there. It seems like a good investment. Also, the way they have structured it, suppose it also goes bad. If I have given 100 home loans to 100 loan borrowers, of those 100, if you go to any historical data or anything at all, you would see that hardly 2% or hardly 4% of the people fail to make their payment for EMI on the home loans. So it is pretty safe. It is pretty safe to structure those products in different chances. Even for those 4%, think about it, even for those 4% who are not able to make the payment, it's hardly a risk because you can always take control of the asset, the home in this case, and you can sell them and you can make good the profit. And we all know what happened in 2008 later. So since 2008, there's a lot of regulatory focus on stress testing, which is essentially taking your current market position, whatever the current market position you have, and applying the stress shocks, which are basically the situation, the things that happen in the time of crisis or in time of challenge, and seeing how much loss or how much exposure do we have. To take an example, let's say in from January 2008 to August 2008, let's say, Nifty fell by 60%. Today, we do not have that crisis, but several regulations will require us to price all the equity options that we have in Indian markets and mark it by 60% down to see the worst case possibility of what can happen, what may happen if this situation comes up. Stress testing is something like operations management has gained a lot of traction over the years because of its usefulness in the numbers. Again, I'll take you to remind the Basel's first pillar, which talks about capital adequacy. And if you remember, uh, anyone can feel that is perhaps not the right way to file out the capital calculations. It's just a number multiplied by the exposure. On a bad day, in a bad year, the numbers can go anywhere from anywhere. So stress testing helps us with that. In the recent years, the geopolitical situations are also such that have given a lot of rise to the stress testing. So we talk about Brexit. There's North Korea escalations. Uh, there's global health crisis which is currently ongoing. There is a U.S.-China crisis, the trade war, and these kind of situations you have to, as an international bank, you have to be prepared. What would happen to your forex fluctuation? What would happen in equity? What would happen in credit spread? And what would happen in the probability of defaults? And what are the operational risks also that you are facing because of these challenges? So this is the work that stress testing does in a nutshell. If you would have understood the work that stress testing does, you would have understood that stress testing caters to market risk, credit risk, and operational risk, all three of them. And in addition, it also helps in the calculation of liquidity risk. Those of you who might be aware, many of you would be aware that Lehman Brothers didn't crash because of the solvency failure. It failed because it didn't have liquidity. It just didn't have cash today to pay its obligation, and that's how it failed. So liquidity risk is another major thing. Liquidity risk is not covered in risk management generally because it is traditionally taken care of by the treasury teams, both in corporates as well as financial institutions. But liquidity stress testing is something which is done by a stress testing team, and we have Basel III guidelines. That's fine. So there are four work areas in stress testing that is done. One is market risk, credit risk, operation risk, and liquidity risk. All these risks are stressed by stress testing. Now, what are the themes that would be generally seen in a stress testing? Inside stress testing, the first thing would be obviously to design a scenario. For example, even to take the financial crisis, because I have taken the example of that, what is the period that you will take to define the financial crisis 2008? Will you take the one particular day of 16th August 2008 or 14th August 2008, or will you take a period of 3 months, let's say from 14th August to uh, 14th November, as a period of stress testing to find out how much the stock fails and how much the situation deteriorates? Also, if you remember from my earlier example, you have to maintain the consistency. If USD has appreciated against Euro and Euro has appreciated against JPY, you cannot have a scenario wherein JPY appreciate against USD. JPY has to appreciate against. So you have to take care of all this. The first thing that does it is called the a scenario design team. This is the team which designs the scenario. Now, the names can be different, the work will remain the same. They use several third-party algorithms, internal data to come uh, to design the scenario which accurately reflect the probable coming situation in the future and the scenario. Uh, this team needs to have a very good idea of the economics and how the different variables are connected. And again, depending upon the specifics, there can be some credit risk specialist in it, some market specialist in it, but that's fine. So once you have designed the scenario, that this is the scenario, if global health crisis continues till December, then these are the parameters change that we are looking at. Then you need someone to uh, implement this system. As I told you, there are 1 million resources. You have to design something, you have to code. So when it comes to coding, you may think that an IT engineer can code it. What are the needs of us? While I come to a skill set later in the job, the implementation team is not only responsible for coding into the system, but also to make sense of the numbers that are thrown out by the system. What if current scenario, otherwise well predicted because of the position, is showing a lot of gain in a situation where there couldn't be any gain? Such kind of analysis needs, such kind of UATs also needs to be done by stress testing implementation team. Also, as I gave you the example of earlier, that the changes in the market can be absolute or relative. If there is a negative 80 basis shock because of certain reasons, the interest rate can go in negative, and that can cause valuation failures. In those cases, they have to take care of the valuation failures as well. Once the scenario has been implemented, you have the data and you have to report it to somewhere. All the regulations require extensive details on the stress testing because this is where the focus of regulators is. So there is generally a reporting team which works on creating the reports and maintaining consistency in the reports and taking the controls over this. And we also have a middle office team here, which takes care of the checks and balances and adjustments and all those things which MRMO, with their counterparts in MRMO and CRMO does. To summarize, in stress testing, you prepare your firms to be ready for the worst. You can do it through sensitivity analysis or scenario analysis, and there are basically the team involved which designs the scenario, the second which implements the scenario, third which reports the scenario, and fourth middle office which actually takes care of the small few checks and balances and adjustments and those kind of things. That was all from me, Ganesh, from stress testing. Anything you would like to add?
Thank you very much, Ankit. This was wonderful description about the entire stress testing team, and I'm sure people would have got a clear idea about what all different teams are within stress testing. So it's not a one role as such. You might have different roles within stress testing so that you can apply for and look forward to join that career. And I just a small query that Ankita from our audience basically asked if the stress testing team will also take care about the change that we see in the market with respect to COVID situation. So I'm assuming that that is what also test testing team takes care of, right?
Yes,
Okay.
yes. In across the banks, global health crisis is a major crisis for all the banks and financial institutions across the globe, and all the banks, which I'm aware of, are continuously and having a daily reporting of their stress testing scenario related to GHC. Also, since you have asked this question, I would like to mention it that when you're a bank, you also need to see uh, what may happen if the GHC global health crisis continues for, let's say, 1 month. What if it continues for 3 months? What if it continues for 1 year? So in different scenario, even in one, like the person asked, the one scenario on global health crisis can actually be three or four or multiple scenarios, which gives a more broader and accurate picture to the senior management.
Thank you very much, Ankit. Thank you. So I'll move to the next set of question. That is primarily, what are the other smaller teams that we have within risk management, and wherein at least somebody can look forward to enter into those teams, and then later can move into a particular interest area, like say market risk or credit risk. So what all different smaller teams are available, and what all different roles do you see within a bank within risk management itself?
So the teams that we have discussed are generally the largest teams in number of size. But but risk management has several other perks as well, which needs to be done, which needs to be taken care of. And for these, some other teams are also there. For example, I'll start with my team. I'm in risk and control, and I act as an internal consultant to the risk management in different functions. Why is that team important? Suppose you, why is that important? Suppose you have a very good functionality that you develop in credit risk. It can be something on the Excel, something on the computation, something that they did in Python that is replicable and will be very useful for stress testing or market risk as well. Now, credit risk and MRM as the part of BAU cannot many times see these synergies and the benefits. So you need someone with oversight across functions to take care of these things. Also, it is very hard to judge and criticize our own work, isn't it, right? So, risk and control and the functions like this provide an independent uh, oversight over the work. Like it can be a small project development. For example, a system was developed in a function, and you need an independent oversight. Now, where will you go to an independent oversight? Suppose the system was designed for CRM. Suppose the system was designed for CRM. Now, if you will, the CRM people themselves were involved in the testing and the design and the project related requirements, they might not be able to understand the certain risks and the situations and the regulatory requirements where this may fail. So for these things also risk and controls come into the play. Sometimes there are regulatory asks where you have to check with so many different functions that you need a special team which is looking across the function and can bring all the views on the table in one go. For those things where we work, we also work in so many looking after the governance of the new technologies. For example, your team can have a robotic process automation. You can apply RPA in your systems. So you need someone to look at the governance, that whether the governance is done properly or not, and those kind of things. So this is what risk and control does. Another team which is very important but is generally of a smaller size in banks is the MO team. This talks about data management. There's a lot of data that we talk about, and after BCBS 59, there's a renewed interest in the data field. So this is the team that looks across all the data, and in case of any issues faced in the data quality, in any uh, valuation failures, they highlight it to the proper teams, and they take care that the data that is provided to different teams is sacrosanct. Otherwise, it will be just a garbage in, garbage out situation. There is also a new business group. No matter how old you are or whether you experience of 120 years, there's always a new client or a new product which you would have never catered earlier. And with a new client or a new product, or even to a completely new product to an existing client, there can be a different new sets of risks that the potential risk that you're open to. These kind of things are taken care and monitored by new business group. There can also be the functions like risk HQ, CAO, and other smaller functions which cater to smaller roles and very specific and very important roles in the firm. Just to give an example where the teams can be very small but extremely important is policy team. Policy team across the globe in a bank can be 3 or 4 person member team, and it might be less than 10 even for the biggest of the banks. But the policy and procedures are very important because whenever a regulator comes, it asks you about your policy and procedure and how the things are going up and how the things are actually designed by you for the things to happen. This is the what you can say, the first basic defense that you can have, and so on. There is these teams are there. My personal advice that I earlier also mentioned to you guys, that in case you want to be in the risk management, the times are not very good right now. If you are very much interested in market risk and you are getting a position in somewhere else, please go for it for the moment, because internal moments are always there. You can always get a chance, and many a times. Uh, Another, I'll quote a personal example here. One of my friends, he was not interested in a particular role in this market, and all his friends were looks flashier and fancier roles, to be honest. So he was not feeling that great about this, and it was a kind of daily BAU kind of role where you go in and go out and you do the same thing. That's what the jobs are for. You don't really like them, right? So, but still, he was not happy. 6 months down the line, he was put up in a project which required him to travel across the regions. He travels to all the regions where the bank was. And it is not about the traveling and having fun and everything. It's about the international exposure and the kind of overall global project exposure that he got to have by this role. So you never know what future has in store for you. So yeah, please think about all the roles and all the possibilities and all the opportunities. That was from my side on this. Ganesh, any questions here?
Nothing as of sort. So there have been few questions related to the generic skill set or generic how do anybody move into your risk side. So we'll be covering that. Now let's go to the final thing, which is primarily some tips and advice. What all different skill sets that you feel that anybody who wish to enter into particular role within risk would ideally need to have, and if we can also talk about your personal experience with respect to CFA or FRM, these courses, how does these courses have helped you in your career? That would also be beneficial for the team, for the audience.
The first one is the general tip that I have already given you, that just go ahead with the role that you get. Now, this the first tip that you have given, that the go ahead with the roles, that go ahead with the possibility and the opportunity that you get. Now, coming over to the more specific of it, and I'll start with Ganesh, who mentioned about CFA and FRM. There are two ways to look at it. The first is that there are so many CFAs and FRMs in the market today, and for every opening, if you will see, there will be 160 or 200 odds applications. And this is the harsh reality. I feel really sad when there's so many of good candidates are applying for so fewer roles, that in an ideal world, we would all perhaps prefer to take the interview of all those 200 candidates, give all those 200 candidates a chance, but that is not possible. So you have to skim through the resume, and you have to come to a place where you have certain. Now, for that thing to happen, you need to have either of the two things. A, you can have experience in that field. That is sufficient if you have knowledge. That is sufficient to go through if you have relevant experience. The second thing is CFA and FRM, where it helps, where I have the confidence in the guy that at least it has some basic understanding of the product. But frankly speaking, if you have the experience and if you make it to for the interview round, then only your knowledge, and not even your knowledge on that particular day, despite being the best knowledgeable person around, you can, so that can be a bad day. So that performance on that day and the knowledge that you really have matters, because no matter what you have heard in MBA or CFA or FRM, the real work is very, very, very different. I can, okay. Ganesh, can you just take one small example that may shock some of the audience here?
Yeah, please go ahead.
Ganesh, I will ask this question to you. You are the trainer, right? Uh, what is the what is the option delta of a call option?
Primarily when the underlying asset of the option changes, and how does that change the option price?
And where it raised from? What is the value that it generally has?
So it ranges from 0 to 1.
What if I say that
It's a
call
call
option
option.
can be negative, the delta can be negative in a call option?
It can be negative also, but that primarily
Yeah.
pertains to your put option, right?
No. In call option, the delta can be negative in real markets.
Right.
So I'll give you the example, and these things are only when you really work on the things and you really see the things in the market, then you see such things happening. Call option delta is something which is always considered to be positive, but it can be negative in case of a particular class of call options, up and out call options, where uh, if you've heard about the barrier option, a call option means suppose the market is currently 100, trading at 100. You have a call option which has a strike of 110. However, there is a condition attached to this option that if the market price is 125, it will no longer, it will be nullified. There will be no value left to it. So now think about it. What will happen to the option as it inches closer to 125? If the market price is 115, your option price is going up. If it is going 116, it's going up. If it is going 121, its price is going up. But once the underlying price reaches 123, there is a probability that it will now cross 125 and your option will be worthless. So what will happen to your original pricing? The delta P by delta C, your option has become now negative. Sorry, delta C upon delta P has become negative, and delta becomes negative also. So there are so many things that you will actually learn on job, but at least the basic things like the definition of vega, definition of delta, what is the probability of default, what is the loss given default, expected shortfalls, different types of R can be calculated, is something that we would not like to tell to even the new joiners. And even if someone tells it to new joiners, it doesn't give a very good reflection of the new joiner knowledge and other things. So those are the things that you must prepare yourself, irrespective of the role you are applying for. You must know your derivatives well, you must know your financial statements well, and you must know the different things that are happening in market right now. Like right now, on the technology side, there's a lot of focus on Python, Power BI, Tableau, and you must have good experience, good knowledge of Excel, because Excel is our tool. Excel is the tool that finance uses everywhere. Everything. This is the general skill set which is required. Now I'll move on. If there is any question here, I'll take it, or otherwise I'll move on to the specific additions and the specific skill set that is required for that at the team levels, like at market risk, credit risk, and so on.
So Ankit, I mean, a few general things first. I mean, so definitely, like you said, there are a lot of for a particular role, there are a lot of people out there who wish to apply for it. So definitely, you're having an international degree like FRM or CFA would definitely help you to go ahead of those candidates and be able to differentiate yourself, your profile or your CV in the market, right? So
Hmm.
that is definitely what the audience want to understand. So what's your take on that front?
If I be very particular, FRM is something that helps a lot because it gives you a mathematical background as well and the economics background as well in very short course. With all due respect to CFA, the accounting sections and the ethics section consume a lot of time in preparation and a lot of time in discussion, and they might not really and directly add to the roles in finance or risk management many a times. Uh, Even for the very deep dive financial analysts where it is required, many a times CAs are preferred for those roles who have done particularly on accounting. However, as I told earlier, FRM is actually very good. I love the course, the way that it combines the economics and econometrics and mathematics and everything in one place. It is also very good to understand the regulatory perspective in the market with a complete part two focused largely around the different regulations and how to play out, and there's a large part on operation risk management there as well. You get an understanding of how the risk is managed and what are the things that can affect the risk management in a bank. In CFA, I personally, for those who cannot do an MBA or who do not have the time, CFA level one actually gives largely all the things that an MBA in finance will teach on a large. Not everything can be taught in a small course, but largely you will get everything. CFA level 2 is a fantastic course. That's my favorite course of all time. Even if you are not able to write the examination because of time constraint or because of some other constraint, CFA level 2 is something which which gives you a complete background of all the calculations, and it gives you the confidence. Suppose the systems fail or you're not able to find out whether the numbers are realistic or not. It gives you a theoretical basis to calculate FRAs, swaps, everything on by yourself. That's a great course. CFA level 3 particularly focuses on wealth management, as Ganesh would be knowing. And that is something that I will not say relevant to this role, but they will be relevant to several other roles. Finance.
Thanks, Ankit. So few of the audience is asking question. The few of them are primarily from accounts team or accounts side, and they wish to enter into investment banking side. So what is your advice to them?
Uh, the advice will vary a lot on the person's situation. What is their experience, and even in accounting, what are they doing per se? The easiest way out will be to internally move to a role in market risk management or credit risk or related roles in their own organization. Because if they are currently in accounting, it is high probability there will be some role related to finance in their day-to-day function in their own organization. Because once you have that, then it becomes easier for the interview for you to get a chance at the interview. If, however, that is not possible because of not so good managers and not so flexible environment, then I would suggest them to take a course of CFA or FRM, wherein we can have a broader understanding and knowledge about the subject. Because a full-time MBA, to be honest, is not possible for everyone. And even if you do a full-time MBA for the heck of it, the institution becomes very important where you are placed, and you are spending not only money on it, but the 2 years of your time. So for them, I will suggest the first step, try to find out, to summarize, I'll first try to find out a relevant role which takes you one step closer to the final role that you want to do. The second step, you showcase on your resume, get something that tells me that you are up for it. For example, I'll take one example here. The climate risk is very up and coming field right now. All the challenges of climate, and climate will have real devastating effect on the agriculture and other things and so on for as a cyclic as a effect. It will have a avalanche effect on the other industries and other places as well. So GARP itself, Global Association of Risk Professionals, have launched a course which specifically focus on climate risk now. So when I have that climate risk on the resume and I see the candidate that has done, it shows me two things. Number one, this guy has some interest in the climate risk. And the second, it tells me that this guy has some basic understanding of it. I mean, after all, these are the two things that I want, right? And the third thing is work ethics and other things which anyway I can judge or I can make some decision on it on the basis of interview and other things.
Thank you very much, Ankit. So there are few questions which are pertaining to. So Pradeep is asking if a lot of these roles related to risk analyst level role today generally ask you to have a skill set with respect to SQL or Python or R. So what's your view on that front?
As I told earlier in the general also, perhaps this question came before that, but I'll repeat myself. A lot of roles are now moving to the techno-functional with the advent of technology in financial markets. You cannot just be a subject matter expert in market risk, credit risk, and expect very welcoming heart from organizations and other things. We work a lot on Excel, so advanced Excel is a must, and then you need a lot of some exposure to Python. Earlier it was VBA, now it is more in the side of Python where you need exposure. Then you have to report that number somewhere, right? So for reporting that number, you will need some exposure to the reporting tools like Power BI or other things. And finally, uh, so there is definitely a requirement on the techno-functional side because in the cost-cutting environment, regulations are coming every day. You cannot have a functional specialist who is only working on its MRM market risk domain or credit risk domain and hire a separate person who is taking care of IT requirements, developments, or creating an Excel tool or other things. The work is just not like that. Python will definitely be an add-on. Reporting tool, Power BI, etc., will definitely be an add-on. Depending upon the organization, some organizations work a lot on SQL, some organizations work a lot on C. So, depending upon that, that is fine. But as long as you have some experience in programming like Python or even VBA, that is acceptable, that is understandable, that you will learn a new language. Actually, we are running out of time, Dinesh. So I will very quickly
Yeah.
just run through the specific skill set that is required for each of the roles. The basics that is
Mhm.
required for all the roles I have already covered. For market risk management in particular, you should be very good with Black-Scholes model, its assumptions, how does the work play out, how will you list an option, the different questions regarding the options. You should understand the options and options very well. For credit risk role, you should have a very good understanding of the financial statements, P&L statements, cash flow statements, and those kind of things. You should have an understanding of how credit spreads plays in the world. As in, these are the things which are required for the credit risk. Operation risk, operation risk is a very specific role, as I told you earlier also. Operation risk is so wide in its overall understanding of the market that you should have a good thorough understanding of all the pieces of the puzzle. Plus you should have a risk mindset. If you cannot like, this is one thing that I have always appreciated in operation risk team person, they have such a risk mindset that they can find out the risk and they can identify the risk. So even when you are in the role, you have to develop that mindset to capture the risk. What is the possible risk that can happen? Because it is a risk from day-to-day processes, day-to-day happenings, day-to-day possibilities and events. For stress testing, you should have a very good understanding of how the market moves, what are the triggers that move the market. Even if you're going on implementation side, you should have a good understanding of the pricing of the products. For example, if 10% of the forex movement is there and 5% of volatility movement is there, what is the expected outcome? What direction option should move, or what direction credit default spread should move? CDS should move. That is there for stress testing. For risk methodology, the question pertains more on the model development. You should have a very good understanding of Python, Monte Carlo. Again, pricing of the financial products is very paramount important. For both market risk, stress testing, and RMG, you need a very good understanding of how the products are actually priced. That will take you not only in the lead, but give you a lot of confidence. And if that thing is there, you can internally move across these roles. There shouldn't be any problem with a good knowledge of Python or any other programming language, depending upon your organization. It can be R or it can be MATLAB. For model validation is a pretty tricky role because you are thrown out with so many models all the time. When you have to do a black box testing, and you're not even aware what is inside the model, and many times you have to test as an independent person. So stochastic calculus is required there, advanced mathematics is required there, and knowledge, a good knowledge I'm talking about here, a good knowledge of MATLAB or Python would be highly preferred, because there is a lot of mathematical modeling and a lot of doing. You need to have a mathematical mindset. Like, what is the mathematical mindset? Just very briefly, if in global health crisis the organizations are failing, we all know that aviation industry will be hit hard. But how hard they will be hit and what will be the impact, that mathematical quotient you should be able to draw back. And a lot of focus on stochastic calculus and stochastic probability is required in those fields. In other roles, in risk and control, you need to have a basic understanding of each and everything, and you should relate to at least one function knowledge domain extremely well to do well. In fact, the teams that we have, one guy was earlier in consulting, the two are from CRM specialist, and I am from MRM and STG background. We That is largely all for NMG and DMO. The roles are very specific, and depending upon the organization and their approach to the role, job description can vary. But yeah, whatever we have mentioned till now, there's a basic underlying knowledge will always help, but the specifics can vary a lot. Like, it's just a lot between the organization.
Okay, thank you very much, Ankit. We have two questions for you, but before that, I'll just quickly answer a few of the small questions from the audience. So Urvi was asking where exactly we can look for job opportunities in risk management. So there are a lot of job portals available where you can go and look for search for risk management related roles. We do run a Telegram channel for students to wherein we post job related information on a weekly basis, and we pass that information to students so that they can apply it on the job itself. And coming to Ashwin Agarwal's question, So Ashwin, when Ankit was specifying about climate risk, what he was ideally telling you is that you need to have some risk related background if you wish to come to a risk side. So FRM will definitely help you. And in case you wish to move towards the climate side, then climate risk related roles, then climate risk certification will help you. So I'm assuming that we have been able to answer your query. Now Deepika was asking if Indian CFA, because she has, if I'm not wrong, that she has done Indian CFA, will that take any value in the current scenario along with FRM? So definitely Indian CFA has his own standing, but right now, since a lot of students are doing US CFA or the international CFA, so definitely they will have some kind of an advantage with respect to that. And having an FRM along with your Indian CFA will definitely add value to your CV, so no doubt about it. So definitely go ahead with that part. Next, there is one query from Nilesh specifically asking that whether because he's looking out to move from a operations side to a senior role. So he's already at a senior role, and if he wish to move down to a senior role within risk, so what all different broader skill set that he should have? So Ankit, can you guide us on this part? If he wish to move from a senior role within operations to senior role within a risk side.
There are examples where this thing has happened, where the internal movement have taken a senior person from operations team and other teams, which were from finance team and operations team, towards risk management. To be honest, these changes are few and far between, because what happens that even the person who are already in, let's say, risk management, needs to be promoted and moved internally to a senior role, and they are given preference over. However, if you have a very good experience and team management experience and exposure in an organization, that can definitely happen. Uh, for that to happen, however, you need to have very good grasp of the day-to-day working of the teams that happen. Now, since you're managing the role, I don't think that so senior leaders need to have a very good on-ground understanding of everything that is happening. But they must have an understanding of, let's say, if I talk about risk, how the data is flowing, what are the counterparts, what are the regulatory requirements, how do they fit in the regulatory requirements, and how and what could really work in your favor is that you get in touch with the risk team and other very senior leaders of risk management, and if they are aware that that this guy is looking for the role, and they otherwise you have a good visibility and you have a good work, then that will help. It will be a combination of factors, because you already said that you're a senior leader. As Prithvi told, the senior leaders position in the Indian job market, it is tough to move in any market. When you have a very senior leadership experience in one particular domain, it becomes harder and harder every day to move to a newer role and a newer place. But a combination of factors like knowing about what the role offers and what you can offer to that role, good visibility towards those who can rather push you up, and those kind of add you up. We are running out of time, but I'm trying to stretch it a few minutes more, Ganesh. Please let me know if there
So
is a question. Yeah.
yeah. So one more final question. So Milan was asking primarily that he's primarily into the from the trade middle office team, the operation side, and he wished to move to the risk middle office team. So will that be an easy move from his current role perspective?
That these questions cannot be answered unless I have the experience and some background of the type. But since this question is asked,
Okay.
I'll make a general statement. It is very, very easy. In this particular case, it is easy, particularly if he is in the starting first few years of his job. Why? Because he is particularly into the trade middle office role. A trade middle office role and a risk middle office role has many overlaps. It is not like the senior leadership of operations or the senior leadership. Here, the overlap is very high. The both of those talk about the reconciliation. Both of them talk about data quality checks. Both of them are very global in nature, and both of them actually uh, create and clean the output for the next level of selection. So at this level, it would be easy. He should find some friends in the middle office uh, who can, in kind of in the opening, quickly pull his resume, and then they should be doing it.
Okay, thank you very much. And final one question from the from Ashwin Kumar's side. So he's a technical analyst and he was looking out for a better role. So he was asking if FRM could help him. So moving from the technical analysis side towards the risk side. So FRM, I am assuming that FRM definitely will help the candidate, and he has an experience of around 10 years. So definitely, I'm answering on your behalf, Ankit now. So definitely, Ashwin, this FRM degree or any global certification will help you to move towards the this side of the compliance side or the risk side of the business. So that is definitely helpful. And there are few question. Okay, so it's more or less we have been able to answer a lot of questions from the audience side. And in case you guys still have any particular queries on the screen, you should be able to see a WhatsApp number. You can put down your query to us, and we'll try to revert back to you as soon as possible. And we'll be having such sessions in future also, pertaining to different specific roles within the organization, like corporate finance, like treasury, the contrast side, or any other specific role. So do stay tuned for our updates, and we'll be opening up. Some of the sessions will be specifically for our students, and some of the sessions will be open to all. So we would need your participation on that side also. And finally, I would like to thank Ankit for taking out his time, and it was such a wonderful experience to understand in and out from somebody who's there in the industry and who has seen different companies and seen the risk in detail, and to get the detailed analysis of those things, and finally giving his own input with respect to what are the different skill set that each team would need. So that is very, very helpful for the students and for the candidates or the audience. So thank you very much for that. And we do look forward to have you in future sessions also, wherein we can have a discussion on a different topic altogether.
It was a wonderful experience for me as well, Ganesh. Good work and all the best. And thank you everyone for taking out time today. It's really great. Thanks a lot. Thank you. For any queries, you can reach out to Ganesh, and I will take it from there if required. I'll be very happy to help you. I can do it. Thank you. Thanks a lot.
Thank you very much, Ankit. Thank you very much, guys. In case you have still queries, you can put it down on the WhatsApp number mentioned on the screen, and we'll try to revert back to you as soon as possible. Thank you very much, guys.
Bye. All the best to everyone. Bye.
Bye. Take care, guys.